This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Here we are again, the Wealth Roundup for the week of September 24th, 2025, with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Patrick, I've been watching the markets, actually more intently since you and I started doing this podcast than perhaps I was in the past. And it's been really interesting to see how the market has been moving. The TSX in the last 3 months, it's up 12.5%. In the last 1 month, it's up almost 6%. So it's been moving along pretty well for people who are invested.
Yeah, and the good thing so the thing about the market is that it's a market of individual stocks. The TSX composite is kind of just a measuring tool, kind of a yardstick. Consulting firms, the Standard & Poor's company creates various market benchmarks that have individual constituent companies. The concept there is to give you kind of a relative idea of the overall health of a market. So, the S&P 500, so, 500 companies in the United States, market weighted. We'd have the S&P TSX 60 here in Canada. You're looking at a trend where the relative direction is either up or down. And for the most part, it's because we have these constituent companies having a net either increase or decrease, or, occasionally you can have the market moving sideways for a while. So it doesn't necessarily always mean that every Canadian company is doing well, but you generally have that weighted average of most of those companies doing well or doing poorly, kind of giving you that call for the day. How's the market doing today? And so that's kind of say a measuring tool. And so I would say that within the Canadian market this year, the banks, which kind of have an overweight within the TSX, they've had a very strong run, kind of after a couple of years of being very sideways. And so, kind of a lot of strength there, even though in any given week, you could see, 2 or 3 companies come out with something maybe negative to their overall stock price, is that we're really kind of talking about the group. And you're right. Since we've been doing this podcast, we can't stop doing this podcast, Terry, because the markets have been very, very strong since we started.
Well, that's for sure. And even though inflation was up a smidge from the last measure, the Bank of Canada did lower their interest rate for a quarter of a point. What exactly happens now as a result of that rate cut?
So, the inflation is supposed to be the primary mandate of the Bank of Canada. So they call it kind of a single mandate, whereas the U.S. Federal Reserve, so the U.S. Central Bank, they've kind of got a dual mandate, full employment and inflation. There probably are some critics out there that are kind of looking at the Bank of Canada saying, inflation it's not low, it's kind of on the higher side of neutral, yet, the Bank of Canada decided to lower rates. And you can't but think that, they're looking at that high unemployment numbers in Canada, relatively high unemployment numbers, thinking that, the Canadian economy needs a little bit of a push, needs some help. So both banks kind of delivered a quarter of a point rate decrease. Currently BMO is forecasting one more for the year. So that December rate decision, we'll have to continue to see, but, just thinking about tariffs in general are inflationary. So we should be seeing, some higher prices flowing through the system. One of the other things we want to talk about was the impact of these rates on mortgages. And so I think there would have been, a number of people that maybe have a mortgage coming due. I think we talked about this in the last podcast. About 30% of all Canadian fixed rate mortgages are coming due over the next 12 months. Just kind of checking with my banking colleagues this week, is really no change in fixed rate mortgages for the week, but anybody that was in a variable rate mortgage would have got a quarter of a point decrease. And so right now, the variable rate mortgage and the fixed rate mortgage are around the same, about 4.75% on a variable and about 4.65 on a fixed. So they're kind of in that sweet spot together right now for mortgage rates.
Last week, we talked about covered calls as part of, a method, I suppose, of drawing your retirement income. There are many different methods of doing that with differing risks, I suppose. What do you have for us today?
Yeah. So I thought, as we could kind of talk about this retirement income 2.0, we talked about medium, investors that, generally when we're looking at their investor profile, we would consider them to have, say, a medium risk tolerance. And so I thought it would be useful to talk about strategies for conservative investors. And I think conservative investors are kind of in this really tough spot for going and generating a retirement income just because yields are so low, interest rates are so low that if you feel like you need a certain amount of income from your investments, is that when you're looking at 5-year government of Canada yields around 2.71, is that kind of sets the level for where you're going to see bank term products and anything that is a bond, either a government bond or a corporate bond. And so I think really for these conservative investors is that, yes, yield is important, but probably what's more important is liquidity. So being able to access their capital when they want to be able to access their capital, and credit quality. So, what's the probability that if I invest, I'm going to get my money back? And so all those factors are really important. If we were to go back 20 or 40 years, one of the products that people used to use were Canada Savings Bonds. So Canada Savings Bonds quietly died out in 2017. I actually had to look that up because I completely forgot that they had discontinued the Canadian Savings Bond program. So most of that market is kind of met by guaranteed investment certificates that are either offered by a bank or a credit union, or a trust company. What's kind of the standout there is something called Canadian Deposit Insurance, which is a federal government guarantee which protects Canadian deposits, so things in bank accounts and term products, up to 100,000 Canadian for the issuer. And so this doesn't cover things like stocks or mutual funds or exchange traded funds or insurance backed products. This is really these bank and credit union type deposits that you might have in, say, your RSP or your non-registered account or your bank account. And so that's pretty important. And it's for deposits that have this insurance, it's very reflective of how safe they are. But the other thing that can kind of factor in here is the size of the institution that's offering these investments. And so you tend to see the big six banks. They're very well capitalized. Globally, Canadian banks are very highly regarded for how cautious they are, how well run they are. And so, because the underlying entity itself is determined not to be very much risk, is that they don't tend to offer a very high interest rate on their deposits. They'll maybe offer more if they're trying to seasonally entice some capital, or if they need more money for their loan book, maybe rates go up. I think what's interesting now is that investors can tap into a variety of these bank issuing type companies through either their broker or from maybe their do-it-yourself investment platform. Is now you can invest in GICs from 20 to 30 different institutions from one platform, which gives clients some additional CDIC insurance. But I think what's become more popular is you see investors that are a little bit more sophisticated yet conservative, is they're tapping the bond market. And the interesting thing about the bond market is that you've got similar security levels, you've got similar yields, in some cases, maybe slightly higher yields. But bonds tend to pay out their income with more frequency. And so most of us have to pay our bills every month. If you've got a term deposit that only pays interest once a year, that's not going to be very good from a liquidity front. Bonds in general tend to pay their income semi-annually. Therefore, an investor can put together a portfolio of bonds and probably generate some income on a monthly basis. And one of the products that we've been using at Leonard Wealth Advisory here for the last month that's been really helpful to us is these target date exchange traded funds, which are a pool of bonds that are set to mature to cash annually. So makes them different than, say, traditional bond mutual funds where the bonds are kind of managed for you, but there's no maturity date. Bonds in the portfolio mature, the manager takes the bonds and and invest them again long term. And that there's that kind of continued cycle. And so investors are kind of forced to go and do their own redemptions or take off their income. But I really think that these target date exchange traded funds are an attractive product because they're very much like going and buying a term deposit. Yet you've got a pool of bonds, and there might be 20, 30, or 40 large blocks of bonds, all of a certain type. So maybe investment grade, maybe government bonds, and you'll always know what calendar year they're going to mature. And in general, they're set up that they always mature in the same month. So it might always be November of a certain calendar year they mature. And then the investor can decide what to do with their capital. So I think there are some other ideas out there for conservative investors that we can source for them by providing them some advice. But I also think there's a growing marketplace for investors of that type as well.
Very good. Last week, moderate. This week, conservative. I'm guessing next week we'll tackle something a little more aggressive with drawing from your retirement. Thank you very much. Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. That's the Wealth Roundup for the week of September 24th.
Have a great week, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.